That fear of recession has kind of cooled down a little bit.
The new CPI report is out, and for the first time in years, inflation is below 3% in the US. Here to break down what it means for the markets is MarketBeat analyst Thomas Hughes. Thomas, this is a pretty big deal. 2.9% just getting in under that 3% rate we haven't seen in a long time.
Right. 2.9% is good. To me, that's not so much the news today as the fact that the CPI was really as expected. The headline number was a little bit cooler than expected on the year-over-year comparison, but still right in that range. I would call it a Goldilocks report, not too hot, not too cold.
So, not too hot, not too cold. And it also means nobody's really reacting to it that much today. What's the market doing this morning?
Yeah, the market really isn't doing too much because this aligns with the outlook for the FOMC for them to cut rates next month. It has kind of tempered the expectations for cuts. Just last week, the market was expecting 225 basis points cuts next month, but now it's only going to be one. That shows that fear of recession has kind of cooled down a little bit. It's still in the background, but it's not as in the forefront as it was. Ultimately, it looks like we're still on track for a soft economic landing.
Yeah, this is a big turn of events after just last week or 2 weeks ago, we had such a huge spike in fear. Talk a little bit about what that was about and how this report really helps.
Well, so the fear is the uncertainty in how high interest rates need to be for how long for inflation to come down to the target level without causing a recession. So the spike in fear was because the labor data wasn't bad, but it has been trending kind of negatively, and that just raised fears of recession. So what this CPI report does is temper those fears. The market is a little bit less scared, but it also keeps sector rotation in play because with the FOMC expected to cut rates and us still on track for a soft landing, what we can expect is for them to continue cutting rates into next year and to spur broadening economic strength and a stock market rally in stocks outside of the blue chips and large mega cap tech stocks that we've seen for the last 2 years.
Yeah, a lot of those stocks have really been struggling in this interest rate inflationary environment. Which stocks are poised to really benefit from this rate cut that's expected in about 3 to 4 weeks?
Well, the companies that are going to benefit most are the ones that are the most exposed to debt because high interest rates makes it hard for them to access capital. They need capital for operations and for growth. As far as companies that need to use debt for operations, those are the smaller companies. Anywhere from a micro cap to a small large cap stock is going to be impacted because they're really dependent on bridge loans and operational loans just to keep the cash flowing on a month to month basis to be able to pay the bills. Some of the stocks that I would really expect to see take off in a lower rate environment are discretionary stocks, in particular, anything to do with housing or the automotive sector. Those two sectors, the consumers are incredibly impacted by higher rates. So when rates begin to fall, we should see the housing market and the car market become unfrozen.
And so, if you're an investor, you're looking at these different sectors right now, you're looking at a good CPI report today. What does your investment look like right now, even trying to get in before these rate cuts come?
Well, right. So there's a lot of volatility in the market still. Fear is coming down, but we've got a lot of mixed earnings reports, and the outlook is still kind of mixed. Right now, we're looking at a market in a wait and see mode. The S&P 500 may continue to rise in the near term, but with sector rotation in play, I would expect to see it peak out again pretty soon. Right now, the best thing to do is to target those stocks that you think are going to do well and wait for any dips and buy them on the dip. We need to remember that it's still 4 weeks until the first rate cut is going to come, and it could be months before the impact is felt by consumers. So we are looking at an economic shift, but it's probably not going to happen for a few more months at least, maybe 2 or 3 quarters, where we start to see it showing up in the data.
Okay, Thomas, this rate cut is expected. People have been talking about it for weeks, months, really. But is it really a guarantee that we're going to see interest rates come down next month?
I mean, it's really not guaranteed because we cannot be assured that the FOMC will follow through on what the market expects. We also have another critical inflation read due out before the next meeting. There might be two. I'm not sure if there's going to be another CPI before then, but we'll get the PCE before then for sure. The PCE is the Fed's favorite tool. If the PCE is contrary to trends, the Fed could back off of their timeline. If the labor data comes in strong, they could back off their timeline. So we really are in a wait and see period to see what's going to happen.
Everyone's looking forward to the rate cuts, and it's something that a lot of people want to happen. But are there any potential risks with cutting these rates?
Right. So the risk really is as it has always been. If the Fed cuts rates too soon or too much, they will reinvigorate demand and they'll reaccelerate inflation. We can see the risk of this already in the mortgage refinance numbers. Last week, mortgage refinances surged by 35% because rates are at the lowest level in over a year. So if the Fed follows through on rate cuts, they cut too much, they're going to reinvigorate demand across the economy with oil, with housing, with for debt with companies, and that's just going to spur up demand throughout the system. It'll keep prices high, and so then we'll be stuck in this stagflationary period where inflation doesn't really come down and rates don't really come down and economic activity is okay, but it's not really the way that we've been pricing in for the last year.
Well, we will keep track of all of it right here at MarketBeat. Thanks for breaking all of this down today, Thomas. And thanks for joining us. Stay tuned and happy investing, everyone.